Yes, the US CPI inflation number for October has come as a huge relief, and now there are hardly any expectations on the CME Fed watch of any rate hikes from the Fed in the current cycle. But there is another important thing that we should watch out for. As the year draws to a close, 2023, brokerages are writing their strategies and economy forecasts for 2024. Among the first off the block is the Morgan Stanley report, which is very upbeat on India, Indonesia and Japan, among other countries. But it sees only a modest recovery in China. So for both the inflation numbers and for the 2024 trajectory, I'm being joined by Chetan Ahya, the chief Asia Economist at Morgan Stanley. He joins us from the sidelines of their investor conference in Singapore. Chetan, good morning, and always a pleasure having you with us. Yours is an excellent report which is speaking about asynchronous or divergent growth in the various Asian countries. I want to get to that in a minute. First, this huge fall in US yields. Is this the base case we should work with? That it is not 5% 10-year, but more likely, 4% US 10-year, and therefore a big relief for countries like India?
That's right, Latha. So we were expecting that the 10-year bond yield will go down. By second quarter, we are building in 10-year bond yield to be down to 4.2%. And then by end of next year, we are building in a 3.95% for the 10-year bond yields. So this is the trajectory that we had forecasted. But of course, yesterday's data has done a very swift shift towards that number that I mentioned to you as our forecast.
Okay. Time permitting, I'll come back to the US trajectory. Now, for the excellent reports that you have on Asia, your expectation is that India is going to be one of the fastest growing or one of the prominent economies in 2024?
Yeah, that's right. I think India will still continue to be the best domestic demand alpha opportunity within the region. And we're expecting growth to be at 6.4% next year in 2024 calendar year. And I think the key story that we have been highlighting on India is that major shift in the policy that is now focusing on boosting private investment. It's something that is critical, because I think India's story in terms of the initial recovery, which was more operating leverage improvement and a cyclical rebound from the COVID lows, now needs that support from the investment side. And we are seeing that the policy setup is such in India that we should get that continued support from the investment side. And that's really the key premise for our forecast, which is at 6.4% next year, which puts India to be the highest growth country amongst the major economies in the world. But more importantly, in terms of Asia, it will see a much bigger contribution to growth. And for global, we are expecting India to contribute about 17% to global growth in 2024.
Okay. Well, I'm coming to the Indian picture in a bit. And of course, later I will also be speaking to your India economist for more color. But your report is very interesting for a central point it makes, that in the first 2 decades of the current century, there was a globally synchronized up and down. I mean, when the developed economies did well, it pushed up all boats. But now all economies are divergent. Can you explain this theory? It's really interesting.
Yeah, so I think what we used to have was, DMs recover first, and that helps to drive Asia's exports, for example. If you think of Asia as one big part of the world ex-US and Europe, and then we will have a synchronous recovery. And the key feature of that synchronous recovery would be a big rise in global trade. And whenever you tend to see improvement in global trade, you have a follow-through in private investment. So it tended to be a quite vibrant synchronous recovery in every cycle. And similarly, on the way down, we would see that global trade would go down, and that will affect everybody's growth in emerging market and in Asia. But what we are seeing post-COVID is every economy opened at a different point of time. There was a difference in terms of the policy response. So, for example, we all know that the U.S. had a very aggressive fiscal policy response. And similarly, in case of China, as we saw, that it was going through some structural challenges which kind of affected their pace of recovery. And at the same time, you are having countries like India, Indonesia, and Japan, which have their own structural drivers which are pushing their domestic demand to be in a better shape. So every country is going through individual dynamic in terms of growth. And so idiosyncratic factors are driving growth stories across the world. We don't have a single big factor that is unifying the global business cycle at this point of time.
Okay, fair enough. Now, there is, of course, an expectation that because of the Fed rate hikes, the US growth is, and generally DM growth, is going to temper down in 2024. Will that impact India? Won't it impact India?
So we think we have been already going through this weak external demand for some time. It's almost like 12 months now that external demand numbers have been weak for everybody in the region, including India. So in fact, we are expecting that there will be a modest improvement on a year-on-year basis. Exports growth will be modestly positive. It had been declining for the last few months, but it won't be that strong. So it will still be a challenge that the external demand will not be a big support. But as you know, we have been seeing that India's story has been really driven more by domestic demand, and that story still continues. And there is nothing that should hold back India's growth rate because of the weaker DM growth. The aspect that actually mattered for India is that as inflation problem was still continuing to be acute, and then the U.S. fiscal deficit rise and the bond supply increase took the U.S. 10-year bond yields higher, the dollar higher. That was in some ways constraining financial conditions for India, not in a big way, but in a modest way. And then now that factor will actually go away, as we just saw that 10-year bond yields declined yesterday. And the Fed was also pushing back on that rise in the 10-year bond yield. So to the extent to which the 10-year bond yields in the U.S. have peaked, I think it's actually going to be beneficial for India going forward.
Oh, got that. Let me come to the country which we don't normally discuss, but which figures prominently for you, Japan. Japan is going to be a bright growth story, you say, and you're actually expecting a rate hike. What does this mean to countries like India? You know, will Japanese funds themselves go back to the home country? Will, you know, even global smart money chase Japan rather than India? Are we going to have any negative or positive impact? First, the Japan story.
I don't think it should have any negative impact at all. In fact, what we have seen is in the last 12 months, you've seen that in Asia, the two markets which have received a lot of inflows are Japan and India. So they've kind of got money in together. So I don't think Japan is sort of competing with India for funds. But Japan's story is just an independent story. I don't think India is linked in any ways to the Japan story.
Okay. Well, now let's come to China. Are you expecting that China is going to suffer from that debt and deflation loop, the real estate companies and the local government, over-leveraged positions? What's China per se, and what will be its impact on commodities, on India, etc.?
So we are watchful of that risk. In our base case, we expect that disinflationary pressure that China is facing right now will improve somewhat. Either there will be lesser of that pressure going forward. But we think that, to the extent to which they are still taking time to rejig their business model from investment-driven to consumption-driven, the challenge of lowflation, if not deflation, will persist and stay with us for much longer than what the market is looking at. In terms of impact on commodity prices, at this point of time, they are managing their real growth rates in a stable range of around 4 to 4.25. And to that extent, I think the commodities demand is being held steady. The only segment of commodities which are affected by China's slowdown is the property sector, and therefore the demand for things like long steel products and to some extent iron ore. But bulk of the other commodities which are dependent on infrastructure spending, let's say on green capex and energy transition related capex, That is still continuing in China, and so those commodities are doing still okay. And then finally, food and energy are anyways completely different, and energy demand, as well as we look at the data, is holding up quite stable in China.
Well, let me end with an India question. I know you are extremely optimistic on India, and so are many of us here. But let me throw some skeptics, play the devil's advocate. We had that Fitch report which pointed out that potential growth for many Asian countries is much lower after COVID, India included. They see potential growth far lower, probably about half a percentage point lower than what it was pre-COVID. And even now in India, we don't really see your rural demand as we would like it to be. Most FMCG companies are still complaining of low volume. And finally, there are still doubts over private capex. We are still government capex pushed in terms of economic growth. Any worries about both the long-term potential growth and the medium-term, capex cycle worries?
So I would just point out, for potential growth, the best indicator would be what is happening to investment to GDP. And investment to GDP had been seeing a very long period of systematic decline. I think it was last peaking in somewhere around 2012. And since then, we had been seeing this significant decline in India's investment to GDP. And that has troughed. And we've now seen a proper reversal in corporate capex to GDP. And at the heart of it is corporate profit to GDP. So as you would have seen some of the work that our strategist Rhythm Desai has done, it shows that if you look at corporate profit to GDP, it troughed at around 1.5% of GDP. And this is the bottoms-up aggregate, not the national income account corporate profits number. But the bottoms-up aggregate number was 1.5%, and it's up now to well above 4%. And if you look at that chart of corporate profit to GDP versus investment to GDP, it is very tightly linked. So in our view, the corporate sector profitability improvement and the way the government has gone around trying to incentivize the corporate sector to improve their business dynamics by reduction of corporate income tax and this PLI scheme has helped to revive that overall investment to GDP number. So in my view, I don't think that if you just look at investment to GDP actual trend, that you can say that India's potential growth has declined after COVID.
Okay. Well, that's very good to hear, and a convincing answer. Thank you very much, Chetan Ahya, for joining us. At the moment, the market is reverberating to optimism. The rupee is a good 25 paise stronger than what it was at close on Monday. Bond yields are a good 8 basis points lower. Bond prices have really shot up by a rupee. And of course, the stock markets are jingling with triple-digit gains. We wrap up on that note. Chartbusters up next.